Okay, my class mocks, IGCSE, it's actually Jan 17 when we did the paper, not Jan 16, as it says here at the top. Very quickly going through them. State whether the true or false about a statement of account. Remember, a statement of account is sent at the end of the month by the supplier to the customer, and it's a summary of all the transactions. So therefore, it's false. It won't contain details of the quantity and price of goods supplied. It'll just contain the invoice total. False. It doesn't show any trade discounts given because the trade discounts given appear on the invoice. What appears as a figure after the trade discount. It shows the balance at the start of the period. Yes, it does, because it shows how much the customer owed as a first line. And it reminds the customers to send the amount owed. There's always a little bit at the bottom explaining about any cash discounts and how quickly the customer's got to pay those if they're going to receive the discount. Complete the following table indicating who would issue each document. Well, Dilip is the trader and he's selling to James. So Dilip will will send the invoice when he does the sale to James to let him know that the goods have been sent. The credit note will also be sent by Dilip because the credit note is sent by the supplier to tell the customer that they've got the goods back and they agree that they are returns, and therefore the debit note will be sent by James. Debit notes are sent by the customer. Name the book of prime entry where each trader would record a credit note. Well, for Dilip, he's the supplier or the business doing the selling. So for him, it would be in his sales returns journal. Whereas for James, he's the customer. He purchased it and returned it, and therefore it's in his purchases returns journal. Invoices, they are sent when the goods are sold. A credit note is sent when goods are returned, and a statement of account that is sent at the end of the accounting period, or usually every month. And then we got a question that we needed to do where James owed Dilip $300 at the start. If James owed Dilip in Dilip's account, so it's Dilip's account, James is a customer, he owes him some money, and therefore on the 1st of March, he would be a asset. And then if we look through here now, we'll just very quickly go through the rest of the answer. A sale was made, and the sale was made for $620, but they took the trade discount. We record the amount in the account after the trade discount. So 80% of 620 is 496. He made a payment for the $300, but he got a 3% discount. So 3% cash discount. The cash discount does get shown as a discount allowed is $9. So therefore the bank part must have been $291, and they are both reducing the amount of money that James owes Dilip, and therefore go on the credit side. There's a sales return of 144. The list price of those goods was 180. However, we know that James gets given a 20% trade discount, and therefore we only reduce the amount of money that he owes the business by the amount after the discount, work out the balance carry forward, work out the balance brought forward, and the job's a good one. And then the last couple of questions were, I think, quite easy. You should really got these. State where James's account would be included in Dilip's statement of financial position. So old name for that is the balance sheet. Well, it would be a trade receivable because James owes Dilip the money, and the section would be the current asset section of the account, not as some people did. Some people actually just put trade receivables in for both. And state why somebody's entitled to a cash discount. That is for early payment of money owed. Just give me a second. I'm just going to pause it while I look at the next question. Okay, on to this next question, the depreciation question. A lot of you found this difficult. Calculate the depreciation which had been recorded on the old motor vehicle at the date of the disposal. Well, if we look on here, what we needed to have done, I'll just find the answer. We got to calculate the 2 years worth of depreciation. A lot of you didn't read the depreciation policy. She provides a full year's depreciation in the year of purchase and none in the year of disposal. So if we look at the dates carefully, she bought it on the 1st of April 2013. So she owned it on the 31st of December 2013 and the 31st of December 2014, but she didn't own it on the 31st of December 2015. And we're going to provide a full year's depreciation the year of purchase. So 31st December 2013 a full year and 31st December 2014 a full year. So 10% times 0.25 gives us 2,500 as the depreciation for the first year. For the second year, we find out the net book value of the carrying amount of this vehicle, which is going to be 10,000, take away 2,500, which is 7,500, times that by 0.25, and that comes to 1,875. A lot of you didn't read what the policy was, and quite a few people did part year, particularly in the first year. Some of you did some disposal for year 3, and quite a few of you didn't add up the total of the depreciation provided, which it asked you for in the question. It then asked you for the motor vehicle account. It only asked for the motor vehicle account for the year ending 31st December 2015. Quite a few of you wasted time doing all 3 years. Okay, but the balance brought forward on the 1st of Jan will be 10,000 because we don't do anything, any adjustments in this account for depreciation if we're doing reducing balance. That 10,000 has got to go to the disposal account because we've disposed of it, and you put in the date of the disposal. We bought a new vehicle, the business bought a new vehicle for 17,000, credit bank, debit the motor vehicle account, and therefore the balance carry forward has to be 17,000. For the depreciation account, the first bit, if you've got this calculated, you shouldn't have got this wrong. The balance brought forward on the depreciation account had to be 4,375 because that was the 2 previous years' depreciation. All of that has got to go to the disposal account because we've disposed of the vehicle and therefore we don't need any more of that provision in the accounts. What you did need to do was calculate the depreciation on the 17,000 new vehicle. And remember the policy was a full year's depreciation in the year of purchase. So 25% of 17,000 comes to 4,250. That goes on the credit side because it's a provision. Provision's got an R in it. R is the right-hand side, which has an R in it, and credit, which is the right-hand side of the accounts, has got an R in it. So credit for the increase in the provision and balance carry forward on the debit side. If you got the rest of it right, the disposal account shouldn't have been too bad. You've got the 10,000 for the original cost. Provision for depreciation goes on the credit side because we debited the depreciation account when we got rid of it, and we debited bank or cash, credit the disposal account, and therefore overall there's actually a small profit on disposal here of 1,585. Looking down at the rest of the question, name the financial statement which a provision for depreciation occurs. I don't like that question particularly, or particularly when you look at the answer. They wanted you to say statement of financial position. The actual provision does appear there. It's a change in the provision, the new provision that appears in the income statement, and it appears in the non-current asset section because obviously we subtract it. What other accounting What's the name of the other accounting? I always look at the question. Principal is involved. It was, besides accruals, state aid depreciation is an example of the accounting principle of accruals. What we're doing, we're putting a expense in for the motor vehicle to match periods of usage, and therefore we're writing off the value over its useful life. And another accounting principle, which is applied when depreciation is provided, they wanted prudence. I would have given you the going concern principle as well, to be honest. And types, when we use the revaluation method of depreciation, tends to be for things like small value items where we've got quite a lot. For example, loose tools, crockery, I would have given that type of thing. And the final question, this was generally very, very well done. So the final question was this one here on defining an income statement. It's got the expenses and revenue, and it's done for a specific period. Why would the owner be interested in it? Well, the owner wants to know that they're making a return on their investment or a profit. Other people that would like to or would look at it, credit supplier, they want to know if they're going to get paid. A manager, to see how efficient the business is working. You've got the bank to make sure either they're going to get paid or can offer a new loan, and the government wants to make sure that they are getting paid. State one use of a trial balance to check the arithmetical accuracy of the accounts and to check for some errors, or for preparing the financial statements. Where do things appear? This is just a straightforward dead click question. Machinery is an asset, debit. Bank overdraft's a liability, credit. Inventory is an asset, debit. Capital is a liability. Purchases are an expense, or you can think of them as an asset. It doesn't matter, it goes on the debit side. Discount received is a form of income. Carriage outwards is an expense, as is carriage inwards, and trade receivables are an asset. Question F said, which accounts are assets, which are liabilities? Machinery, inventory, and trade receivable were the three assets. You should have got them all. Quite a few of you missed one of them. And the liability was the bank overdraft. When a trial balance fails to agree, we open a suspense account and name and explain two errors which would not affect the balance of a trial balance. You could have gone for any of the big six, so omission, commission, principal, original entry, reversal of entry, or compensating errors with a quick explanation. Right, guys, thank you very much, and hopefully looking forward to paper 2.